Spokane's multifamily vacancy has stabilized at 7.3% as absorption finally catches up to deliveries. But unlike the national narrative of a rapid recovery, local rent growth remains stuck in a flatter, more grounded reality.
Yeah, that's exactly what we are seeing on the ground right now.
Welcome to the Deep Dive. We are unpacking the Q2 2026 multifamily market for Spokane and Coeur d'Alene, or CDA as we'll call it for short.
And just to set the baseline for you, all figures cited are from the Q2 2026 market report.
Right. And in under 20 minutes, we're going to give you the competitive edge on this market.
Absolutely.
Also, if you want a custom market breakdown tailored to your specific assets, you should reach out to broker Eric Peterson at 509-903-9077. So what are the core headlines we need to be looking at this quarter?
Well, to set the framework for our discussion, we can really distill this quarter down into four major data points. Number one is demand and supply.
Okay, what's happening there?
Absorption is tracking evenly with new deliveries right now, and that equilibrium is exactly what is leveling off our vacancy rate.
Makes sense. And number two?
Number two is pricing. Asking rent growth is essentially flat, sitting at a pretty microscopic 0.6% year over year.
Wow, just 0.6%.
Yeah, barely moving. Number three is the capital markets. We are looking at a subdued 12-month trailing sales volume of roughly $124 million.
That sounds pretty low.
It is. And finally, number four, the forward outlook. Construction starts have plummeted by 50% from their cycle peak, and that provides a massive signal for future supply relief.
So how would you sum all of that up for someone listening?
I mean, if you remember one thing today, it's this. Spokane's multifamily market has entered a mature phase of stabilization. The wild swings are over, and steady is the new normal.
I want to explore this idea that steady is the new normal, because if you read the national financial news, the headlines tell a completely different story.
Oh, for sure. There's a huge disconnect right now.
Right. Nationally, forecasters are shouting that vacancy has already peaked, construction is down by over 40%, and rent growth is revving back up, heading toward a healthy 2 to 3% mark.
But locally, we are nowhere near that.
Exactly. You just said we have 0.6% rent growth. Wait, if the nation is rebounding and tightening up, why is Spokane seemingly lagging behind with a delayed recovery?
It's super easy to look at those numbers and assume it is a lag, but the reality is that we are simply at a different stage in the market cycle.
How so?
Well, Spokane experienced its major demand peak much earlier than the rest of the country. If we look back, Spokane hit its vacancy peak in Q3 of 2024 at 9.1%.
Oh, so we already had our peak. Why did we peak so early compared to everyone else?
Because we experienced a massive wave of coastal in-migration.
Right, the wave of remote workers fleeing those really expensive tech hubs a few years ago. People were looking for more space and better affordability, and, well, they found it here.
Precisely. That wave drove our vacancy down and pushed our rents up way ahead of the national curve. But today, that specific coastal migration wave has slowed down significantly.
So the gold rush is kind of over.
Yeah. Household formation has cooled. Right now, our local employment growth is just tracking right alongside the national average.
We aren't outperforming on job creation anymore, basically.
Right. So the demand isn't surging. It has just stabilized. We aren't waiting for a delayed recovery. That earlier peak simply means we are now living in a flatter, more mature phase of the cycle.
Okay, so the demand side has leveled out. But on the supply side, there's still an incredible amount of product coming online.
There really is.
Even if groundbreakings are down 50% from the peak, the near-term deliveries remain elevated. The report shows we are expecting roughly 800 units to deliver in 2026, and then another 800 in 2027.
Well, you have to remember that commercial real estate development is not a nimble process. The lead times are massive.
I always think of multifamily development like a massive freight train. Even when developers realize the macroeconomic environment has shifted and they slam on the brakes.
Meaning they start breaking ground on new projects today.
Exactly. The momentum is already there. The boxcars, which in this case are those 800 units a year, they are still going to keep rolling into the station for the next 2 years.
That is exactly how it works. You do not pause a project that has already secured bank financing, poured concrete, and framed 4 stories.
Right. There's no going back at that point.
We are actually watching specific underway projects right now, like the Vistas bringing 227 units, and Northwoods Apartments bringing another 192 units.
So the train has definitely left the station.
Yeah, and those units are arriving. But the crucial metric to watch is where those units are landing. During the peak development cycle, almost everything being built was 4- and 5-star luxury product.
The high-end stuff.
Right, but recently, development shifted heavily into the 3-star segment, the more traditional workforce housing product.
Why is that shift toward 3 stars so important for the market?
Because as those new 3-star boxcars roll into the station over the next year, that is exactly where the new deliveries will create the most vacancy pressure.
That actually brings up a fascinating dynamic regarding renter behavior right now. If the middle of the market is about to get crowded, what is happening at the top?
The top is seeing a lot of movement.
Right, we've got renters flocking to the 4- and 5-star luxury units, essentially absorbing that new supply. But they are doing it because they're being heavily supported by landlord concessions.
Yeah, we are seeing significant concessions at the top of the market. Landlords are offering a month of free rent, waived administrative fees, or free parking just to get leases signed.
Oh, wow. They're really trying to incentivize people.
Because of this, older 1- and 2-star properties are actually seeing their occupancy slip. Renters are taking advantage of those concessions to upgrade their lifestyle for a very similar monthly out-of-pocket cost.
But this raises a much bigger question for me. We have middle and upper income earners who could historically afford to buy a starter home. Why are they choosing to rent a luxury apartment in the first place?
Well, we have to look at the stark contrast in housing affordability to answer that.
Okay, let's unpack that.
Right now, your average Spokane household is spending about 38% of their income on housing, supported by a median home price around $406,000.
That's pretty high.
It is, but if you look over at Coyote County, specifically in CDA, the situation is incredibly stretched. Households there are spending roughly 72% of their income on housing.
Wait, really? 72%?
Yeah, and that's driven by a median home price of $575,000.
Spending 72% of your gross income on housing is just suffocating. There is almost no disposable income left after you pay the mortgage.
It is structurally unsustainable, and this is the core mechanism driving current renter demand.
Because they literally can't afford to buy.
Exactly. With a 30-year mortgage hovering near 6%, it is mathematically impossible for a huge portion of the population to buy a home, especially in Coyote County.
So those would-be buyers are completely trapped in the rental pool.
They are. I mean, if you have a good job and want a nice place to live, but you cannot afford an 8% or 9% down payment combined with a 6% interest rate, what do?
You take the landlord's free rent concession at a brand new 4-star building, you enjoy the pool and the fitness center, and you just delay homeownership.
You nailed it. That's exactly what's happening.
But if high mortgage rates are keeping people trapped in rentals, and these apartment buildings are staying relatively full, you would naturally assume that real estate investors are rushing in to buy apartment complexes in Spokane and CDA.
You would think so.
Right. But we look at the capital markets data, and it shows a very different, very cautious reality.
The capital markets are reflecting a completely different psychology right now. This really goes back to the dashed hopes we saw at the end of 2025.
What were investors hoping for?
A lot of investors were betting on 2026 cap rate compression. They thought interest rates would fall, the cost of borrowing would get cheaper, and building values would shoot up.
Let's pause there for a second because I want to make sure the mechanics of this are clear. For someone not steeped in commercial finance, what exactly is cap rate compression and why didn't it happen?
So, a capitalization rate, or cap rate, is essentially the annual return an investor expects to make on a property if they bought it with all cash.
Okay, so it's a yield metric.
Right. It is calculated by dividing the property's NOI, the net operating income, by the purchase price. When cap rates compress, it means the required yield is shrinking.
And when does that usually happen?
This usually happens when debt gets cheaper, causing buyers to bid up the purchase price of buildings. Investors thought the Federal Reserve would drastically cut rates, making debt cheap and causing building values to spike.
But that didn't happen. The data highlights a hawkish whoosh Fed in geopolitical shocks, specifically Iran-driven inflation concerns.
Yeah, that threw a major wrench into things.
So what does a hawkish Fed and overseas inflation mean for a local real estate investor trying to buy a building in Spokane today?
Well, a hawkish Federal Reserve is one that prioritizes fighting inflation over stimulating economic growth.
Which means keeping interest rates high.
Exactly. When you combine a hawkish Fed with global geopolitical instability that threatens to raise oil and shipping prices, which, drives domestic inflation, the bond market reacts aggressively.
So the cost of borrowing goes up.
Yes. The 10-year Treasury yield, which is the benchmark that most commercial real estate loans are priced against, pushed right back up toward 4.5%.
Oh, wow.
Because the underlying benchmark went up, the actual interest rate a local investor pays on a commercial loan stayed prohibitively high.
So because the debt is still so expensive, the local cap rates are remaining incredibly sticky.
Exactly. Spokane cap rates are holding around a 6.2% market average, and the actual transaction averages are sitting around 6.6%.
And they aren't going to drop anytime soon.
Unlikely. Given the macroeconomic landscape, those cap rates are far more likely to stay sticky than they are to fall. The debt is just too expensive right now.
And we can really see the result of that expensive debt in the transaction volume. The 12-month trailing sales volume is sitting at only $124 million.
Which is a huge drop.
It is drastically below the 5-year average of $189 million. The velocity is just gone.
Tighter lending is weighing heavily on the market. If your NOI isn't high enough to cover that expensive monthly debt service, your DSCR, or debt service coverage ratio, is going to look terrible to a lender.
So the bank just says no.
Pretty much. The bank looks at the cash flow, sees that there isn't a wide enough safety margin to pay the high-interest loan, and they simply refuse to fund the deal.
How is that impacting the types of buyers in the market?
Because of this, institutional capital has pulled back. The current market is being driven almost entirely by private, highly selective investors who either have strong local banking relationships or are bringing a massive amount of cash equity to the table.
Let's actually pivot and look at the actual transactions. Because even with strict lenders and a sticky 6.5% cap rate environment, some deals are getting across the finish line.
Yeah, deals are still happening.
Right. So who is actually buying right now, and what are their strategies?
If we review the trailing 12-month notables, the contrast in asset types is really telling.
Let's hear some examples.
On the institutional core side, we have River City Apartments, which was built in 2025. It sold in Q2 for $7.3 million. That breaks down to $226,600 per unit, trading at a 6.0% actual cap rate.
And that one was pretty well occupied, right?
Yes, notably, it was 97% leased at the time of sale. The buyer was LT Real Estate.
So River City is a brand new build. It is fully leased with essentially zero deferred maintenance. What else is moving?
We saw slightly newer vintage properties like Cedar Ridge Apartments, built in 2020. That sold in April 2026 for $6 million, or $198,300 per unit, at a slightly higher 6.6% cap rate.
Okay, so another solid property.
Yeah, and we also saw a recent Q1 deal, Osmond Apartments, built in 2023. It sold in January 2026 for $2.8 million, about $191,800 per unit at a very tight 5.9% cap rate.
Those are all newer turnkey properties trading right around a 6% cap. But what happens when an investor looks at an older, maintenance-heavy building?
That is where the strategy shifts to value add and the pricing changes drastically.
What's a good example of that?
Look at Espanola Oak Apartments. Originally built in 1908 and renovated in 1988, it sold late last year for $2.7 million, which is $142,100 per unit at a 6.4% cap.
That's quite a bit older.
It is. And then we have a true high-yield outlier, 3270 North Lincoln Street. Built in 1979, it sold for $2.3 million, or $110,700 per unit at a massive 8.3% cap rate.
Wow. I want to explore the underlying math and buyer psychology there. We have River City trading at a 6.0% cap for $226,000 a door, and Lincoln Street trading at an 8.3% cap for $110,000 a door.
It's a huge spread.
That is a spread of over 200 basis points. Does a 200 basis point gap tell us about how investors are evaluating risk today?
Well, just to clarify, a basis point is simply 0.01%. So a 200 basis point gap means there is a full 2% difference in the yield those buyers are demanding.
That makes sense.
That wide gap tells us the market has completely bifurcated into two distinct camps. On one side, you have the River City buyer. They are executing a flight to quality.
They want the safe bet.
Exactly. They are willing to pay a premium, meaning they will accept a lower 6.0% yield because they are getting a fully leased, stabilized asset. They don't want to deal with replacing roofs or managing heavy tenant turnover. They just want secure, predictable cash flow.
They are basically buying peace of mind in a volatile economy. But what about the buyer taking down the Lincoln Street property at an 8.3% cap?
That buyer is a yield chaser taking on significant operational risk.
Because it's an older building.
Right. When you buy a property built in 1979, you are inheriting older mechanical systems, aging plumbing, and the need for constant capital expenditures.
And that costs a lot of money to maintain.
It does. To justify taking on those headaches, especially when bank debt is so expensive that buyer demands massive compensation, they require an 8.3% going-in yield just to make the math work.
So there isn't really a middle ground right now.
No, not at all. Right now, there is very little appetite for the middle. You either pay a premium for safety or you demand a massive yield to compensate for risk.
That makes the transaction logic incredibly clear. Now, all this CoStar data gives us a fantastic bird's-eye view of the macroeconomic trends.
It really does.
But I want to know how these broad numbers align with what the team at Activate Real Estate is seeing internally, right on the front lines of property management and leasing. Does the macro data match the reality on the ground?
Synthesizing the macro data with internal portfolio metrics is crucial. The good news is that the internal data from Activate Real Estate aligns very closely with CoStar's 7.3% vacancy baseline.
Oh, that's good to hear.
Yeah, the narrative of market stabilization is absolutely verified. The buildings in their portfolio are holding steady.
But I imagine there is some discrepancy when you get down to the granular level of actual rent collections.
Yes, there is a vital nuance regarding rent growth. CoStar's top-line data shows asking rents technically holding near flat with a 0.6% growth rate.
But what is the on-the-ground reality?
However, internal, on-the-ground intelligence from Activate Real Estate shows that effective rents are under far more pressure than that headline number suggests.
Okay, let's clarify the mechanism there for you listening. The asking rent is what a landlord lists the apartment for on a website.
Right.
The effective rent is what the tenant actually pays out of pocket over the course of a year, after you factor in concessions like a month of free rent or a waived deposit.
Exactly, and that's a big distinction.
So why don't landlords just drop the asking rent instead of giving away a month for free?
Landlords preserve the asking rent to protect the paper valuation of the building. Commercial buildings are valued based on their NOI.
The net operating income.
Right. If you permanently lower the face rate of the rent, you lower the building's valuation, which can cause massive problems if the owner needs to refinance their loan.
Oh, so they use the concessions as a workaround.
Exactly. They use heavy one-time concessions to get the lease signed. But what this means in reality is that while the asking rents look stable on paper, the actual cash in hand for owners isn't growing at all.
That has to hurt profitability.
It really does. In fact, when you factor in inflation on operating expenses like insurance and maintenance, the true net income might actually be shrinking.
So the best practice for understanding this market is to defer to the internal data from Activate Real Estate to grasp the gritty reality of effective rents and occupancy struggles, but rely on CoStar's verified transaction logic for our sales comps and macro cap rates.
That is the most accurate way to underwrite an asset today.
Bringing this all together for the outlook. For Q3 2026 and the balance of the year, it sounds like the safest bet is to expect demand to simply match supply.
Yeah, that equilibrium should hold.
That freight train of new units is going to be met by a steady stream of renters who are locked out of buying a home by 6% mortgages, keeping the vacancy rate hovering right in that 7% range.
That is the baseline trajectory for sure. But to stay ahead of the curve, you need to watch two things very closely.
What should we be looking out for?
First, monitor the lease-up speed, specifically in the 3-star segment. As those new middle-market units deliver, we need to see if there is enough middle-income demand to absorb them without triggering a heavy price war.
Right, that's going to be a crucial pressure point. And the second thing?
Second, keep your eyes glued to the 10-year Treasury. If it breaks its current holding pattern around 4.5% and shoots higher, it is going to freeze the capital markets even further, stalling transaction velocity altogether.
To figure out exactly how these macro trends, supply waves, and sticky cap rates impact your specific assets, you really need an expert in your corner.
You really do. The market is just too complex right now.
Remember, for a custom strategy session applied directly to your portfolio, you should call Eric Peterson directly at 509-903-9077. He can help you navigate whether it's time to hold, reposition, or capitalize on the flight to quality we discussed today.
I want to leave you with a final thought to mull over, if I can.
Go for it.
We have spent a lot of time today talking about the pain of new supply, that freight train of 800 units a year rolling into the market. But remember the data point from earlier?
Groundbreakings are currently down 50%.
Right. The development pipeline is set to essentially empty out after 2027. So ask yourself, what happens in 2028 when population growth and household formation continue, but there are 0 new apartments delivering? Are we quietly setting the stage for the next massive rent spike?
Wow, that is a phenomenal question. Because even though steady is the new normal today, Eventually, that freight train is going to run completely out of boxcars. Thanks for joining us on this deep dive. We'll catch you next time.